Ladies and gentlemen, dear audience, my name is Christian Gülich. I'm the representative of the German Association of Insured. Our association is an NGO with about 45,000 individual members all over in Germany, with its headquarters in Hamburg. For an annual fee of 60 euros, our members get independent advice on all questions of private insurances, including judicial advice in case of problems with regard to indemnity claims. My task is to represent our association on the EU level. On the other hand, within Better Finance, the European Federation of Private Investors and policyholders in Brussels. And on the other, in one of the so-called stakeholder groups of the European Supervisory Authority for Insurances and Occupational Pensions, EIOPA, in Frankfurt. Desislav and I know each other from these European institutions, and I sincerely appreciate being invited to this conference today. The subject for my presentation we have agreed upon is enhanced digitalization and advice on private retirement provision. The reason why I proposed this subject is quite simple. As probably we all know, there are two major impacts of the ongoing pandemic for insurers in Europe and even worldwide. Due to the measures of social distanciation, there is an enhanced digitalization as well of distribution procedures, as of contract administration and even of claims or indemnity management. And secondly, due to the economic impacts of the pandemic, there is a prolonged phase of low or even zero interest rates, which puts an enhanced pressure on the returns of life insurance products. Under these contradictory conditions, what are the chances for a takeoff of insurtechs in the sector of life insurances? Before answering to this question, I would like to clarify a possible misunderstanding. As far as I know, in contrast to most Balkan states, in the traditional markets of private insurances in Central and Western Europe, the sector of life insurances is much more important than the sector of car or motor insurances. Following to Insurance Europe, the Federation of European Insurers in Brussels, in 2019, the average spend per capita in Europe for motor insurance was 244 euro, but for life insurance, 1,163 euro. So life premiums in Europe in 2019 were in total at about 700 billion euro. Premiums for motor insurances were only at about 147 billion euro, so nearly 5 times less. These figures show why, in the long run, life insurances are much more important with regard to the gross written premiums than motor insurances. But as an independent broker or insurtech, you should not forget that life insurances are, of course, not the only product for private retirement provision. As a consumer organization, we always advocate that private retirement provision is predominantly a long-term saving process and less an insurance problem. That is why the saving or accumulation process should be kept as simple and cost-efficient as possible. For example, by using a standard saving plan of ETF, so-called exchange-traded funds. The only so-called biometric risk, which is linked to the retirement provision, is longevity. This means the life expectancy after having finished the professional life. In Germany, for example, the regular beginning of the state pensions starts at the age of 67. So you have to calculate an additional life expectancy of 25 to 30 years in order to be sure that your probable life experience does not exceed your savings. For this payout phase, there are various solutions. Life insurers offered lifelong annuities. Investment funds offer drawdown plans. Both offer one-off payouts. Any distributor, broker, or insurtech has the legal obligation to give best advice on these various options, as well for the contribution phase as for the payout phase. In consequence, a pension product which fulfills all these different requirements must be simple, transparent, and cost-efficient, as EIOPA stresses. Therefore, on the European level, another new regulation has been adopted for the launch of the pan-European pension product, the so-called PEP. There are three major advantages of the PEP. As an explicitly European product, the saver will be enabled to contribute to the same product, even if later he will work in another country of the European Union. This is a so-called portability service. This may be interesting for workers from the Balkan countries, for example, who would like to get a job in a different European state. The second advantage is that there is an obligatory product standardization. Any product provider has to offer a so-called basic PEP. If a saver chooses this basic PEP, he just has to follow a predefined decision tree, and he will know what will be the kind and the projected amount of the future pension. Because of this obligatory product standardization, especially the basic PEP is convenient for pure online distribution. The basic PEP has an additional advantage of a cap of cost of 1% of the accumulated savings per year. In comparison to most insurance pension products, this cap of cost is quite moderate. But in comparison to pure ETF saving plans, unfortunately, it still is rather expensive, especially in the long-term perspective. As already pointed out, the first PEP shall be offered to customers from 2021 on. Therefore, it is very interesting to look for any pension products which already exist and which may be a model for a future PEP. In Germany, there are more than 50 life insurers which offer all kinds of life insurances and pension products, from classical guarantees to unit-linked or hybrid products. The biggest company is Allianz in Munich, as you may know, and they offer only for private pensions at least 12 products, not taking into consideration occupational pensions. The newest pension product, which Allianz has launched last September, Alvest, has two particular characteristics: pure online distribution and rather low investment costs by using mainly ETFs. Surely, of course, you will find other possible candidates for PEP by making an online research on pension plans of other European product providers. Unfortunately, we can observe in a traditional insurance market like Germany that the established insurers and distributors more or less refuse to promote the new PEP, mainly due to the cap of costs. Therefore, for insurtechs, there is a real chance to attract new customers by a new product and by an innovative way of online advice. That is why I would like to give you one example of an insurtech which is focused on the future PEP as a major tool for private retirement provision. It is based in Berlin and its name is Vantig. Its website is bilingual, German and English, And there you will find all the necessary information, how to give advice and to proceed contract conclusion exclusively on an online basis. So my conclusions are the following. Look at EIOPA's website for detailed information on the PEP requirements. Look at Vantic's website as an example for an insurtech specialized on private retirement provision. And remember that, of course, insurtechs are in a very harsh competition with traditional distributors in all financial sectors, private insurances and retail investments. But the enhanced digitalization creates several crucial advantages. Broad range of target groups of possible customers, low costs by product standardization, and better returns for customers by offering ongoing product innovation. Thank you for listening.
Okay, so the idea was to present to you the perspective from a consumer who is looking for the product he might need to live a normal life. So my presentation is let's say structured on four small dimensions. One is about insurance and inclusion, and I want to present to you what means financial inclusion in the field of insurance. Then let's say presenting to you what we consider, what is being considered as the necessary insurance nowadays in our society. Then I will present to you not all of the issues and content, but at least, in my view, the key elements that maybe put people with higher risk profile at risk of not getting access to affordable product. And then we'll present to you shortly some recommendation for hopefully finding some solution to these issue. So maybe some of you knows already quite well what is financial inclusion, but it's not as such so well known, let's say, concept. So the idea mainly about financial inclusion is about the possibility for everyone to have access and to use the products that they consider necessary to live a normal life and a simple life in the society. It means that, of course, from a country to another, the consumption, I would say, standards are not the same, so they might differ from a country to another. But the exercise is mainly to say, okay, nowadays in a life when you don't access some financial product, of course, here let's say in insurance, it might be a bit less, let's say, visible than in some other financial services. I think about, let's say, payment account that become very much necessary for a daily life, and in some case some credits. But insurance is becoming more and more used and is really becoming, let's say, as part of a daily life. And we consider now that insurance as well do have some products that are very much necessary to live a normal life. Simple life means that the product that you should access should be easy to use, easy to identify, and not creating issues when using them. Why we consider and why we think that insurance can become a necessary product nowadays. Mainly it's for the following reason, even if they are not all, let's say, mentioned, but it's about getting some protection against poverty, homelessness, if you lose your property, if you, let's say, are liable for accident that leads you to very high, let's say, penalties that leads you to poverty, for example, because of lacking any protection, then you are exposed to a risk of becoming poor and over-indebted. It's also questions of guaranteeing the access to healthcare, because you will be able to pay the cost of this healthcare, and notably because you have an insurance. Maintaining a high level of mobility is very important, and in some region, not having access to a car in particular can really create some let's say vulnerability as regard reduction of employability, and also as regard let's say a minimum standard of living. When you are family with children with no car in a rural area, you are very much restricted in your choices. In other, let's say, another range of reasons are also about the legal requirements. We know that motor insurance is an obligation, and it's a EU directive who is ruling that. And in more and more, let's say, situation, the obligation, the requirement is based on contract. And we think, for example, in some countries, getting access to a let's say home insurance when you access to a mortgage credit is already an obligation by contract. In other case, landlords are requiring some home insurance as well for the tenant. So what are the product on which I would say there is more or less for the time being a kind of consensus and a common view, not only from consumers protection organization, but also from the industry. And we can say more or less, it's not an official consensus, but the four products presented here are more or less, let's say, considered by not only consumers, but also insurance firms as becoming very much necessary to live a normal life, which is the motor insurance already mentioned because of the legal obligation. These household and home insurance because of these high protective effect on risk of poverty and homelessness. These third party liability insurance, which is also bringing a quite high level of protection against life accidents and financial, let's say, consequences. And then we mentioned the health insurance, the private one, which means the one that sometimes is necessary to complement the public health scheme that might be in some countries rather insufficient. And I think, for example, to cover hospital expenditures or some, let's say, complementary treatment that are not covered by the public scheme. Here, I think it is important to mention more or less one of the key element of competition that in my view is at the root cause of this risk of not having access of affordable insurance for higher risk profile. Let's say that the risk-based pricing includes different type of risks, and it's not only the claim history, which I and other consumer protection organizations consider it's definitely the fairer, let's say, rating factor for assessing the risk. But we observe, and of course, the digital evolution and will bring much more capacity for insurance company to, let's say, access particular risk assessment from personal attributes. So I try to range them mainly on attributes that are attached to identity. So identity is about the age of the persons, the address, the gender, the marital status, potentially the professional status. Those are elements on which people might not have, let's say, a direct impact, and or they just, it's really part of their own identity, they can't change it. And other kind of attributes can be more, let's say, considered as being attached to behavior. And we know that the Internet of Things and the connected car can have a view on your driving style, for example. For health insurance, there is a more and more interest on checking if you smoke or drink, if you have some sport habits, or and all these elements that have an influence of your lifestyle. But not only these kind of, let's say, quite intuitive and immediate, I wouldn't say causal connection with the risk, because causality remains quite a challenging notion. But there are also different kind of other let's say, type of behavioral attributes that are checked by financial and insurance companies. And for example, you might be considered on the way you browse on the web. And if you are comparing price of the insurance premium, you might be checked also about the type of devices you are using, or the way you're going to pay on internet. And maybe also insurance company might be willing to access your credit scoring. So this credit scoring, for example, might make some correlation between the way you manage your budget and the way you driving, or your capacity to maybe maybe to pay on time the premium, or even the probability you might be willing to make any fraud because you have financial issues. This is the way potentially insurance might be looking to your behavior. So what is the mechanism of this insurance competition that does not benefit to higher risk profile? Usually, what we observe is that because of these so-called risk-based pricing, the insurance company are looking to attract lower risk. And so they are looking really to be able to identify among the potential clients, customers, the ones that are going to have a lower risk. Because on this particular section of the clients, they will make more, I would say, benefit, but they also will be able to propose to them maybe some lower price, which will attract more of these clients. So the idea is that the more you are attracting low risk profile, and in particular by using big data, AI, Internet of Things, the more you penalize. So the more you are attractive for the lower risk, the less you are attractive for the other ones. So the other ones might be, let's say, pushed to look for an insurance in other companies that might be challenging to offer you, let's say, an insurance at a proper price, because the lower risk people might have left this company too. So it's a kind of vicious circle in which the more you look for the lower risk clients, the less you use these, let's say, increased profitability beneficial for the higher risk profile. It's not as if altogether, because some people are making allow a company to make more profit, it allows this company to make less profit on higher risk profile. This is not the way it works, because the market, there is no obligation for the companies to serve a larger amount of people, and in particular to guarantee services for higher risk people. This is the current situation. So the problem is in this situation, and I hope I will be clear. I have been clear, but do not hesitate to ask for clarification if it was not. This leads that for necessary product, the one I mentioned in the beginning of my presentation, it can be for high risk profile, really becoming let's say, really challenging to access affordable price. And we know that the price is an entry barrier to access some product, of course, and the necessary one in particular. So these are here, let's say, 4 recommendations that I hope would be helpful to let's say, correct a bit this tendency. The first one would be for the EDPB, so the authority of that data protection, let's say regulation, to define what should be the data perimeters to be used for the risk assessment per the different kind of product in insurance. It's very important that the insurance company do use more or less the same type of data perimeters. It will allow maybe to stop this race that leads the company to try to access really sensitive data on personal data, and we consider that we should limit the risk assessment on some data perimeters that are really meaningful, causal, easy to control, easy to detect, and in order to stop this crazy race for more data. Then we consider that the insurance industry should propose basic insurance product in these at least minimum 4 necessary products we mentioned. What is a basic insurance product? It should be affordable, it should be easy to use for consumers, or consumer friendly, and also, of course, easy to identify within the market, because we consider also that the digital offer and marketing tools are not really making things easier for the consumer to identify which will be the best product for his situation. We also consider that companies should report annually to the competent authorities on the impact on this, let's say, inclusion level. Of course, for that, it is important to develop some key indicators that might be, let's say, designed by the European authority. And then, last but not least, I think one potentially of the most pragmatic and potentially the most efficient way for allowing consumers to access a good product, and also then to improve the competition in favor of consumers by the different insurance company, is to develop a consumer-friendly comparison website, but developed by public authorities, which is very important, because we should not have private interest behind a comparison website, first of all, and then public authorities are probably the only one to be able to guarantee that the market is covered by 100% of the offers. And we also consider that a price observatory is absolutely necessary to guarantee that competition leads to, let's say, appropriate offer for consumer. So I finish here my presentation, and I'm ready for responding to questions, but maybe later, I don't know how it will be organized, and I will quit the.
Okay, thank you very much, Oliver. Actually, there are no questions and answers here because we are in Zoom, and the main audience is in a different platform.
Okay.
And Zoom is interconnected to this platform, so we
Okay.
do not have a genuine Q&A session.
Okay, no problem.
Okay, if the other two panelists have any issues with your thoughts.
Yes, okay. Then I will start. I fully agree with what Olivier has said, mainly in 3 points. First, of course, I think you are absolutely right to insist on the necessity of independent comparison website. This is absolutely necessary, because all the comparison websites which exist right now are not really independent ones. They are offered by brokers, and in Germany we have made a lot of, or not only we, other organizations, consumer organizations as well, have made a lot of comparisons, and even some legal procedures against the comparison website, because they did not disclose the fact that they are brokers. So their comparisons are simply not full or not complete. They work like a broker, and it is sure that they do not correspond to to all products which are offered on the market. So this is a false comparison. The second point you have mentioned is the necessity of basic insurance products. This is what I tried to point out, to elucidate by product standardization, which is maybe or hopefully even possible now in the very complicated market for private retirement provision. But of course, for non-life insurance products, as you have said, especially for motor insurance or third-party liability insurance. These are basic products which every consumer needs, and therefore I think the basic product is an absolutely necessity. And the third point, which I fully agree with you, this is a question of use of big data, of artificial intelligence. What we call that the problem of the law of the big number. In fact, there must be a sufficient big risk pool in order to create sustainable tariffs. If the individualization of tariffs goes too far, then on the one hand, there are maybe some consumers which get very low tariffs, of course, and then they make profit. But the question, of course, then the counterreaction is that other consumers which do not correspond to these very low risk profiles, they have to pay much more even for the same kind of risk cover. So I think the only way how to solve this problem is that insurers may be allowed to reduce a little bit the tariff, the calculation of the tariffs, but there must be simply a limit. How much they can go on with this individualization of tariffs. Otherwise, the principle of insurance itself is questioned and fundamentally questioned. This means this famous law of the big number. Thank you.
Thank you, Christian. This is a very good observation, and I just want to enter with my presentation just to highlight the feeling of mess that is going upon us from the insurance sector. My presentation is actually dedicated to the open insurance question, whatever this may mean, and I'll try to start it now. Do you see the presentation now?
Yes, I do.
See it. Yeah.
Okay, yes, great. Yeah. So those are just some basic slides that are going according to one short position paper that we developed in FinTechGuardian, and it's about the open insurance and the potential risks and benefits it would bring to the overall population of insured people. And to our opinion, for the moment, the perils are much outweighing the benefits of it. Of course, from an industry perspective, probably the things look different, but from consumers' perspective, we feel that something is not exactly right here. Just to see how it will go. For one reason or another, it's not changing slides. Sorry. So, what is the situation presently? We have, let's say, two distinctive groups of insurance companies and insurance-related businesses. Some of them are in a very good shape. They are somehow future-prone, and they are able to adopt all type of challenges that our digitalization is bringing forward. And there are, of course, other that are not in a so good shape, especially in, let's say, the periphery of Europe. I don't want to go into country-specific details, but I think people understand what I mean. So our problem is not the first group, our problem is the second one. And where the things start to get funny. The European Commission, according to its data strategy and digital finance strategy and capital market unions, which in paper look very bright, very good, very future oriented, somehow is trying to open the gates and to airbrush all the existing boundaries in the financial sector. Of course, this could create a lot of opportunities. This could create a lot of new working roles, working places. It could create a huge wave of employment, future employment. But one must take it with grano salis, cum grano salis, as it's said, because that type of employment will require totally new set of skills from the people that are there. And we are not very sure that those people are still present at the market, especially the labor market. The other part is that this type of interconnectedness, as you can judge even by our event today, creates a lot of gray areas. And in those gray areas is the interesting part, especially if you take into account that many players on the market are beneficial to the consumers. They do not want to harm their consumers, but there are also others. And those others create a huge peril. I'm focused on those companies that are putting the profit and that do not care much about what's going on with the consumers. And this is not only one or two companies, it's a huge market segment, I'm afraid. So with that actions of at European level, although they look pretty well, at least in paper, I believe, and not only I believe, but I think this is a general notion that in the insurance sector, the mess will get even bigger than the one that is presently existing. At national level, Open Insurance Initiative has also very different degrees of adoption. There is interesting facts that could be observed. For example, at level of national insurance markets, where there are companies with headquarters somewhere in the Western Europe, the so-called more mature Europe, those companies are more well prepared to the requirements and the challenges of open insurance, while the native companies still even lack basic ideas what is this open insurance all about. And here is the issue, and unfortunately this issue is not some strange thoughts of people that are too afraid of the future, but it's coming from the discussion paper of EIOPA. And in the first sentence, you can see that there is no uniform definition of open insurance or open finance, nor is there sufficient settled academic or expert literature on this, as these developments are relatively new. And I think this line says everything. Even the reference framework for open insurance is still not developed, not to mention the fact that there are huge amount of mismatches that exist in the insurance market, and that they will be multiplied by the adoption of the open insurance concept. Some advocates of this concept refer to the open banking and how well it was introduced by the banks. But one should always think of one issue. With banking, we have financial transactions that, although they can have different patterns, but in general they are running in the same level, at the same plane. And this plane is transfer of money, transfer of wealth in a way. While with insurance, you can have all type of risks and all type of insurances that are trying to address those risks. And opening the gates, it means to allow companies that have not been experienced in insurance, that even are not regulated properly or regulated at all, to have access to insurance data, private data, starting from health insurance, going to cyber risk insurance, household in the middle. So it's a huge amount of totally different details that with the concept of open insurance has to be given access to third parties. And we believe that this is a huge issue, and it has a potential for much bigger harm that is originally expected. especially if you put into the equation, for example, a report of one of the biggest investigative companies in the States, published just a couple of days ago, about 17,000% increase in ID theft in the United States, 17,000% since the pandemic, since the beginning of the pandemic. And you can say that the market in the United States is not so poorly regulated. I mean, there is a lot of tools to address those issues, and there are a lot of they even have history of dealing with those type of problems. While here in Europe, ID theft is pretty much new concept in, let's say, half of the continent. So open insurance is again opening the gates in front of barbaric hordes. This is the incumbent answer, especially of those companies that do not use some external help. As I mentioned, those of them that have headquarters in old Europe, they are a little bit more prepared to what's going on. While the local insurance companies, they're trying to use the elevator in times of siege. And I think this picture very well answers to what they are doing. Of course, the barbarians on the other side of the wall. I don't know if you can see the line between the cartoon, but in general, it says, okay, we had this issue during our preparation of course or during our education, but those issues cannot be addressed well stepping only on your education. I mean, those issues could hardly be addressed without experience and real-time, world knowledge. And I'm not very sure that the third parties that are trying to gain access to information that is currently kept within the walls of the incumbent insurers are ready to use it in a proper way to prevent any possible harms to the consumers and to actually to create benefits for the consumers, not to create issues with them. Especially one should point out, for example, the issue with smaller venture capital fueled companies that are doing all type of data juggling just in order to extract the value from this data. The moment you cut their venture capital umbilical cords, they start to bleed, and they are not prepared how to preserve the information that they have gained access to, how to use their models without financing, without centralized financing. And it's not an implausible scenario to see such a company to go rogue and to try to benefit in not a proper way, for example, reselling their data that they have gained access to, or reselling their models to not very legitimate buyers, to put it mildly. Because there is some such thing that is called darknet, and in the darknet, believe me, you can find everything that you are interested in. And insurance information is even not so interesting for the darknet, but you can find it there as well. So I think the open insurance, if not addressed properly, will create a huge additional segment of the darknet market very soon. What could go wrong? I think I already addressed this problem. Almost everything could go wrong. Almost everything could go wrong, starting from the disgruntled system administrator in a startup that has not received his paycheck for a couple of months because the venture capital guy has stopped his financing. So he decides to make some extra cash selling your data to somebody else, although it's illegal. But you can always make this this arbitrage weighting what is the punishment for this and what is the benefit for you. And especially if you are somewhere outside the core of Europe, where you have much more lax regulations and stuff, why not use the darknet for a profit? Also, many companies use third-party services. They use outsourcing. I know that there is certain regulations that is addressing those issues with outsourcing, but it still creates problems, because you outsource something to somebody and then it could be re-outsourced to another company somewhere else in the world. Although the initial outsourcing company is still bearing the culpa in eligendum, so they are put into position to respond for negligence in case they have not selected the proper outsourcing company for their outsourcing process. In any case, this could be issue, and this is just one of the issues that could be created by open insurance. How to solve it? For incumbents, for entrants, and for regulators, they all has to adapt to the digital age, because this I cannot stop repeating this. All companies, and especially the insurance companies, are software companies nowadays. Some of them perhaps still have the notion that they are operating in their traditional environment, but I believe this is not the case. So they have to adapt to the digital challenges and to be able to create new mechanisms for consumer protection at all type of levels. Also, this is an issue for the regulatory bodies, because many of them just lack digital capacity. They lack the skills, the toolbox that is required to be able to oversee in a proper way an insurtech company. If you take, for example, insurtech company, a traditional insurance company that is totally digitalized, and there are examples in that direction. For example, not Baidu, sorry, I forgot the name, but it's a company in China. I even think it's part of Tencent holding. This company actually has no physical offices. They are entirely present only in the internet. You can interact with them only with some type of internet tool. And I hardly believe that present insurance supervision architecture in Europe allows many of the supervisors to address such a company in a proper way. Not to mention, I just don't want to go into details about this or that, or how the Chinese regulator is overseeing and not editing, but making due diligence to the software that the insurance companies are using, just to see if the results that are produced from there are the proper ones. But this is a detail. I don't want to go in that direction. So in general, this is sort of a wrap-up of our position on the open insurance. We believe it will be beneficial in a long run, or let's say the mid-term run, but in a short run, it could be pretty much dangerous for the whole insurance community. And that's my presentation. I'm stopping the share here. And any reactions from your side?
Okay, if nobody else, I just would like to, yeah, again, I fully agree with you with what you have said. This is love. I just would like to point out that in Germany, just a few weeks ago, we had a very strong discussion about the role and the task of our national supervisory authority, because the authority clearly stated to the new insurtechs that their capital requirements must be as strong or as strict as for all the other insurers. This means they have to follow the rules of Solvency II. And okay, if they are beyond it, then it's a little bit, because this is a question of proportionality, but they have to follow these rules. And the National Competent Authority clearly stated that for the capital requirements, in order to give or to guarantee the constant risk cover for which the customers have paid, for this, it is not sufficient just to ask, as you have said, for venture capital on the financial markets. Yeah, there must be a solid basis for a constant risk coverage, and this can be done only in the framework of Solvency II, or with all its proportionality. And so one has to make the difference between what in Britain I think is called the so-called regulatory sandboxes for new business models, but this does not mean that the strong economic support this strong economic support does not or must not be missed. And there is a recent study, just in order to finish, that in Germany we have about more than 180 companies which could be classified as insurtechs. Yes, and there is a clear tendency that they, following to this study, yes, by one of the consultant companies, that they more and more become, in fact, providers for technical solutions for the insurers, yeah, and that those who make really a business like a broker, like a normal or usual insurance broker, they are still in minority. So I think that is something which is very interesting. Yeah.
Yes. I really would start with your basic concept that the regulator is again addressing the insurtech issues in the old way. I mean, it's focusing on capital adequacy and stuff. Well, here the main issue is not actually the capital. Probably those companies will have their capital in a way. This will create some sort of tranquility within the regulator. But their main problem is that, first of all, with open insurance, the idea is to have the whole insurance value chain segmented one way or another. And third parties may start doing business with those segments of the insurance. But also the regulator is not addressing, I think, the main issue. Everybody's saying that the data is the new gold. And do they somehow account for this gold? I believe not. Do they have proper software, but not only software, even hardware? What they do in respect of providing guarantees that the employed software and hardware solutions are a good one, because from our side we are plain users. We are, let's say, not so well computerly literate guys, and from our side something is working well. It's okay, but so what's on the back end? We have no idea. So there must be somebody who says, okay, I checked also the back end, and this software solution is a good one, or this is not a good one, or this is developed in third party, nobody knows where, and this is a huge issue, especially if you take into the equation the modern software, because it's comprised of many smaller parts, and those smaller parts could be developed everywhere. And usually the developers are using standardized libraries, software libraries. They do not code by their own, so they take parts from here, from there, they just mold up something and they push it forward. And this, I believe, is one of the biggest issues with the insurtech development nowadays, and with the open insurance in particular. So maybe Martin and Oliver could reflect on that.
Yeah, can I come in maybe?
Yeah, of course.
Yeah, I just wanted I'll address maybe, I don't know if this is open insurance, but I'll go a bit on the decentralization and blockchain side and smart contracts. I just wanted to come back on the law of big numbers, as Christian was referring to. I think in overall, basically, insurance makes sense for non-foreseeable risks, so-called accidents, which truly happen by chance. And even though there is this tendency now to use vocabulary which may suggest that people can lower their risk by doing this or that, which is, of course, it's not bad per se that people, for instance, eat more healthy or do preventive, exercises to have better health. But overall, insurance is for non-foreseeable risk. If you're going down the individual risk-based pricing, and you're actually starting to insure for a foreseeable risk, because that's the claim. That is, if you have enough data, then you can actually foresee a risk, and then you can price it accurately. Whereas non-foreseeable risk is that you just do a blanket insurance across millions and millions of people because you're unable to extract from that pool people that are more or less risky. If you go down the individual risk pricing route, then it actually doesn't make sense at the end, because then people can just self-insure. Basically, the only reason why you need insurance is if you go down an individual risk-based pricing is for the first few years where you didn't set aside enough money to actually have a pool of money that is large enough in case you have an accident or a problem in the first few years. But after the first few years, when you've set enough money aside, actually you can just self-insure. You can have an algorithm, an open source algorithm that analyzes your data just as well as any other algorithm, that looks at your own data, whether it's health or accidents or whatever, and then just tells you, okay, this is how likely it is that you'll have an accident in the next X years. And after 3 or 4 years of setting money aside, actually, you don't even need to be in a pool anymore, because the chances are that the chances that your pool of money that you set aside is going to go to zero is negligible. And that would be a very dystopian future in a way. It's because it would basically mean that people would only insure and mutualize or socialize risk within very small risk pools for a few years. And then once they have enough money saved up, they just exit the risk pool and say, screw the collective. I'll just cover my own risk on my own. And that is now possible, because ultimately, I think there's a big debate, especially with the open insurance and decentralized insurance. There's a whole question about who does data belong to, because that's ultimately what is really needed. Of course, for large-scale socialization of risk, the data that you need is rather small. All you need to know, for instance, is how many accidents on average, in aggregate, you have in a certain country, for instance, and then just spread the risk evenly and you have your price. But if you go down the individual risk-based pricing, then you need really granular data. Like, for instance, is that driver, how many times have he been caught drinking and driving? How well is he driving? How hard does he push on the brake and all that stuff? And ultimately, that kind of data, arguably, if you look at the GDPR, that data belongs to the person that generated that data. So the individual, which means that ultimately, if millions of users ask for data portability rights on that kind of data that is being collected about them, they can very easily just let an open source algorithm and a decentralized insurance with no third parties involved get them a price for being insured. And that will cost them much less than the current centralized solutions, because of course insurers have staff costs, branches costs. I mean, all that costs a lot of money to have all that staff. And we would go towards a world where you just have bounty hunters, basically. Like if at a certain point the state issues a recognition, official recognition to certain bounty hunters to weed out insurance fraud and false claims, that's all you basically need. Just an open source protocol, decentralized insurance, open data, and then these bounty hunters to make sure that people are kept in check and don't submit false claims or commit insurance fraud. Now, I'm not very enthusiastic about that future, but I think it's basically now the insurance business, the current incumbents have that choice. Either they sort of coalesce with consumer organizations and civil society like ourselves, like Olivier, like Desislav, and they agree that socialization of risk is what they want to uphold to have, at least a certain standard in insurance for everyone, for the most basic insurance products like Olivier underlined. Or if they fail to do that, I'm afraid that they'll just basically they'll saw the branch that they're sitting on, because they will enable the emergence of these decentralized alternatives, which will be inevitably cheaper because they won't have that third-party intermediary costs. Now, to finish, I just wanted to sort of throw a stone in the pond a bit here and be provocative. All of that we're discussing here is based on the assumption that over the next 5 to 10 years, we are going to be in a form of stasis. Well, everything sort of stays the same. We have about 0.5% growth, maybe less or more, you know, and the financial system is fine and everything. But let me just tell you that in countries like Venezuela, for instance, where you have rampant inflation or hyperinflation, the insurance business is not doing too well. And so all of that we're discussing here, the stability of the insurance products and all that for the future, is based on the assumption that we're going to have monetary and financial stability, which is becoming less and less sort of clear. And, you know, I mean, you have examples of things going wrong, for instance, in the US with underfunded pensions in certain states where they cut your pension, that your pension is simply slashed. So just how resilient are our public and private insurance and pension schemes in the event that we have another third wave or fourth wave of coronavirus, or if the stock market, you know, loses 80% of its value. All of these things are potential things that can happen in the future, and we need to think very carefully of what happens then. And obviously then decentralized alternatives may be something that will emerge as well due to this kind of instability, because ultimately there is nothing, it's not as vulnerable basically, because you don't have all that problem with reserve ratios and all that. It's just a vulnerability based on the quality of the code and loopholes and bad programming basically. But other than that, it runs automatically. There is no way that you can be underfunded or overfunded. Everything is transparent. So it's code is law, as you say, in the decentralized community. And so I really look forward to how that will sort of evolve over the next 5 to 10 years, especially if we have wild fluctuations in financial stability. So that's.
Well, I believe this is a very good point, because all our assumptions are really based on the ceteris paribus, and we live in a pretty much turbulent times, and actually nobody can give any viable hint about the future and the future development. So let's hope it's a bright future, although I do not see too many points in that direction. What I was just I wanted to add to your words is that the basic position of our organization always has been that since the data is the new gold, and this gold is actually mined by somebody, but it's created by the user. So the user, first, it's property of the user, and secondly, the user has to be reimbursed in one way or another for using this new gold. And I have heard many voices that actually his reimbursement is in kind, because when his data is used, he's receiving much more tailor-made products for not only in insurance, but in any type of data-driven businesses. But I'm not very sure that this is the only way out. And even a small, not negligible, but a small payment towards the user when somebody is using his data, I think it's pretty much a good concept, especially from a consumer point of view. So, what is your positions in that direction?
Do you allow me to enter here on this point?
Yes.
Yes. Well, it's not precisely this one, but I wanted to go back. In fact, even if we are not going to be there anymore, insurance companies are not going to be there anymore within the next 2 decades, whatever. Nowadays, we still have some right from that came from the GDPR, and when we were thinking about the issues encountered by consumers and the personal data, I think there is 1 or 2 elements on which we should build some let's say stronger protection, and maybe also we have to learn how to use the GDPR to make it more effective. And these are 1 or 2 ideas. The first one is about the consent. as you know, data access, in particular personal data, or even the one related to protected attributes, is always related to a consent that is given by the consumer. And then here, I think there is an element on which we have to work, and we have to force firm not to make that providing data or giving the consent to access data is not a consent, but it's a requirement to access the product. Because if it's a requirement, it's not a consent, it's a condition. And here we can't speak anymore about a consent. So to keep the consent possible, you need to still have access to a product when you are not providing your consent to access personal data. So this is the first element. And this is why, in my view, basic financial services, if the offer is guaranteed on the market, they should be made also available for people who are not generating data because they are not using such device for whatever reason, and it can be poverty or at least vulnerability, but also people who do use such devices but are not willing to share the data, or the one they consider not relevant or whatever unfair to give access to insurance company. So this notion of consent, in my view, is a very legal one, but is a strong one on which we should, the consumer protection, but also the regulator, should invest a bit more, because in my view, for the time being, consent is not properly treated in the let's say in the relation between customers and insurance company. And then the second one, and I will finish after the second one, is about the notion that you have in the GDPR on the fact that the personal data should be accessible only if they are necessary for the conclusion of a contract. And all of a sudden, we hear insurance company considering that having access to credit scoring data is a necessary one. But well, 10 years ago, no credit scoring the database access, and you observe, let's say, a growing insurance market. So you access to product at that time without providing credit scoring information, for example. So more and more, I would say the narrative from insurance company is it's not possible to finalize a contract if we are not accessing these new data, but it is. So here again, I think we need to develop a counter-narrative to prove that on the basis of some certain limited perimeters of data, that might include some personal data. I'm not against that on principle, but it should be enough for a company to make its business, and should be the necessary data, and the minimization of the data collection should be implemented by this new principle, I would say. Thank you.
Thank you, Olivier. I somehow agree with your position, because allowing people to use some service only when they provide their data is not a good idea in any case. And although this is labeled as a consensual use of data, there is not much consent in it. Well, are there any questions in respect to the presentations on stuff, or you want to comment something?
Maybe I just wanted to quickly rebound on what Olivier is just said. I think that we can agree that basically we wanted the legislator to define clearly what is the data strictly necessary depending on the different insurance product, rather than having, I mean, Christian solution is also a nice one, basically setting a floor on how low you can go with your products. But I think we prefer the solution where the legislator says, okay, so for a motor insurance, this is the data that is strictly necessary to be able to provide an insurance contract. And you know, how hard you press on the brake pedal may not be a strictly necessary data point, which means that you know, I mean, it's like by restricting the data basically that insurers can use, it's almost as if they're forced to socialize or mutualize the risk because they cannot go granular enough to identify or penalize those who, those data points would sort of extract from a certain pool. So it grows the pool. It artificially forces socializations of risk. And so this is the strategy, I think, or the road that we would prefer to go on, is like make a list of all of the essential insurance products and then define the list that society basically agrees to democratically, saying, okay, for instance, for each risk, what should we socialize health costs for, smokers and lung cancer? And that is ultimately, it shouldn't be the private market that makes those decisions and prices automatically people out of insurance. It should be a societal, democratically chosen sort of decision saying, okay, how far do we allow people to be risky, to have risky behavior that they know is detrimental, for instance, and they still engage in it. And you still want to have this kind of element of solidarity where, even if, for instance, somebody goes skiing 2 or 3 times more than their neighbor, and they have a higher chance of breaking their leg, you're not going to start penalizing them because they live a little bit slightly more risky lifestyle. And I think that kind of decision should be a societal decision and a democratic decision and not something left to the market. So I don't know if...
I believe this is a very good point, because people have different lives, and just separating the righteous lives against the not so righteous ones is a bad idea, I think.
Okay, if I may just step in, I more or less agree with what has been said right now, especially with the problem of the stress which has been made on the fact that we have to keep a consent on the necessary or the minimum data which are collected. But I think, yes, I see it a little bit different maybe than Martin. I'm not so optimistic with regard to the, let's say, the the self-ruling process of society or of even of democratic or basic small companies. What you have said, especially in a period when, as you have pointed out, that there is very, very strong inflation, or that there is a stock market crash. In fact, you have described a situation in which we have more or less a general loss of confidence in the structures of the financial markets. And I think in such a situation, if we really have this very strong negative general situation for the financial institutions, I personally, clearly think that that the big players which exist now, the incumbents, as it was said, nevertheless, I would have more confidence in these big players which exist already now than in the small ones which can be controlled even much less. If I have understood you correctly, it sounds to me a little bit like Bitcoin, Bitcoin for the money market, yeah. And okay, right now this seems to be a very variable investment, but nobody knows. If we will have a digital euro, then Bitcoin maybe will drop again very strongly, I think. So the point is, who makes the control in order to keep that consent about, I think we all agree upon. And I do not see who else than the state, or especially the competent authorities. Of course, if they really work, if they really look at the legal compliance, the good governance, the risk management that all the small or the big companies have to do. So yes, for that I'm a little bit pessimistic. I think we need still, especially in a situation where we have a very difficult general financial market situation, then we need a strong control, and this control can only be made executed by a state or its representative. This means competent competent supervisory authorities, because otherwise yeah, I think it is simply anarchy. And or what you have said, we have Desislav has talked about the darknet. Yeah, I think and this will be the solution. I'm pessimistic for that.
I do share your pessimism, I'm afraid. So guys, it was a very great discussion actually, and I want to thank you all for participating in it.